In this chapter, chapter 6, we talk about deductions, and this is a big chapter. We're going to cover a lot of the different types of deductions, and there's a lot to get straight in this chapter. So I'm going to highly recommend that, of course, you make sure you watch the videos, and we're going to have at minimum 3 videos. We're going to have a video related to deductions for adjusted gross income. We're going to have a video related to deductions from adjusted gross income, and then we're going to have a video where we review the standard deduction, but also talk about the additional standard deduction and some special rules related to exemptions. So there's a lot to cover. In addition, I'm going to open up some additional optional exercises in the Connect product, because while the homework will give you a good overview, it doesn't review everything we cover in this chapter. So I really highly recommend that you go through and watch those additional, or go through and work those additional exercises that I'm going to open up in Connect for you. Okay, so let's get started. We've got a lot to cover in this chapter. So we'll begin with our deductions for adjusted gross income. Deductions for adjusted gross income. So Congress allows taxpayers to be able to claim a variety of deductions that are listed as FOR AGI deductions. Now remember, we call these deductions FOR AGI deductions because they are classified as above the line deductions. That means in the formula I take gross income and I subtract FOR AGI deductions to come into my calculation for AGI, as opposed to deductions from AGI, which are subtracted directly from AGI to calculate taxable income. For AGI called above the line because they are above the calculation for AGI. From AGI deductions called below the line because they are below the calculation of adjusted gross income. Now there are 3 main types of deductions that are classified as FOR AGI deductions. These are going to be deductions that are directly related to business activities, deductions that are indirectly related to business activities, and then also specific deductions that are personal in nature that the IRS has characterized as being allowed to be taken on the tax return. So let's first begin with our trade or business expenses. So when we talk about our trade or business expenses, we have to define the type of business activity that we're looking at. So if a individual is a self-employed individual and they are operating something like a Schedule C, which is for businesses, a Schedule E, which is for rental, or a Schedule F, which is for farms, all of these deductions are going to be listed as FOR AGI deductions. And the reason why is because these are self-employed individuals that are engaged in business activities, and these are profit-motivated activities. So they're going to be allowed to take a deduction for AGI, an above-the-line deduction. The other difference is if we have an employee of a business, then these individuals are going to have unreimbursed business expenses. And these are going to be deductions from AGI. So if I'm self-employed and I have business expenses, the deductions are FOR AGI deductions. If I'm an employee of someone else and I have unreimbursed business expenses, the deduction is a FROM AGI deduction. So we have to be very careful when we're talking about where trade or business expenses go, whether it's a FOR or whether it's a FROM AGI deduction. Now, if we are self-employed and we are filing a Schedule C is the schedule that's filed if we have a sole proprietorship, and it's the schedule that reports their profit and loss from their business. Schedule C is a part of the 1040. So on Schedule C, they're going to, of course, list their income, but they will also be allowed to deduct their expenses. Now, Congress has stated that business deductions that are expenses that are allowed can only be related to the activity, and the business expense has to be ordinary and it has to be necessary for the business. This means that the expenses have to be appropriate. They can't be like way excessive expenses, and they have to generate profit for the business. Now the Schedule C, let's take a look at that schedule. I have that exhibit pulled up. So this is the Schedule C. This is posted in your book for you. And you can see that on the Schedule C, the first part of the Schedule C that we list is the income section. And then the second part of Schedule C is where we list out all of our expenses. And you can see that most of what you would consider to be regular expenses are allowed. Things such as advertising and insurance and rent and taxes that the business pays and utilities. So this would be our Schedule C. Now, similarly, we have a Schedule E. And a Schedule E is what we use for taxpayers who are generating rental or royalty income. We're going to concentrate on the rental side. This is page 1 of the Schedule E. It's where taxpayers put in their rents and royalties received. And Schedule E is essentially an income statement for the taxpayer's rental or royalty activity. Again, this is a taxpayer who is in the business of doing rental activities, such as an investment type activity. You can see it's set up very similar to the Schedule C. You have the income that's listed at the beginning, and then you have a series where you can put all your expenses. And most of the expenses that would be associated with a business are listed here and are deductible. Now, as a reminder, we also have another type of deduction that's allowed that we've talked about in some detail in other chapters, and that is losses. Remember that a taxpayer that disposes of a business assets or other assets such as capital assets are allowed to deduct a loss on their tax return. Now, there's special limitations that are subject to the taxpayer depending upon what type of loss it is. So remember, we have talked about the fact that if it is a capital loss, a loss that occurs because of a capital asset, we've disposed of a capital asset at a loss, then that capital loss is limited to a deduction on the tax return of $3,000. So we can net all of the loss against capital gain, but if there is no capital gain left, then we can only deduct $3,000 against our ordinary income, such as against our salaries. Remember, the remaining portion that is not used is carried over to the next year. so that I could then deduct it in the following year. Now, another type of deduction that is allowed for taxpayers is a flow-through entity deduction. Remember, in the previous chapter, we talked about the fact that some taxpayers invest in things such as partnerships or S corporations. The income that is provided off of those investments is taxable. Therefore, the deductions that are provided off of those tax returns are also deductible. So, expenses and also losses that are incurred through partnerships or S corporations are deductible as FOR AGI deductions. And they are reported in the specific place that they're related to. And they also, and the information about those deductions and the income is reported on page 2 of the Schedule E. Now let's talk about deductions that are indirectly related to business activities. So deductions that are indirectly related to business activities. The first of these deductions that are indirectly related to business activities are moving expenses. So a taxpayer is allowed a deduction for the cost of moving their personal possessions. In order for an individual to qualify for the moving expense deduction, they have to meet 2 tests. The first test that they have to meet is they have to meet the distance test. And to satisfy the distance test, the IRS says that the distance from the taxpayer's old residence, so their old home, to their new place of work must be at least 50 miles more than the distance from their old residence to their old home. From their old residence to their old place of work. That didn't make any sense. Okay, I think it's helpful to draw a diagram so we understand this. So let's say that here is their old house. And here is their old work. And let's say here is their new house. And let's say that here is their new place of work. Okay, so the first thing we're going to do is we're going to take the old residence to the new place of work. And we're going to find the distance between that. So let's say that that distance is 5 miles. Old residence to new place of work, okay? And then the next thing we're going to do is we're going to take the old residence to the old place of work, and we're going to compare those two. So the old residence to the old place of work, let's say that's only 1 mile. So in this case, we would do 5 minus 1, and we get a difference of 4 miles, and we do not meet the requirement. It has to be at least 50 miles. But let's change the scenario. Let's say the old house to old work is 5 miles, and now the old house to the new place of work, let's say it's now 60 miles. So we'll do 60 minus 1. I get 59 miles, and I meet the requirement because I'm at least 50 miles more than the distance from the old resident to the old place of work. Notice in the distance test, we do not care about the new house. I don't care anything about the distance between that to anything. I only care about the distance between the old house to old work and old house to new work. Okay, so that is the distance test. Now, the taxpayer also has to meet the time test. So in order to get the deduction, they have met the distance test. In addition, they must satisfy the time test. So the time test tells me that the taxpayer must be employed full-time for 39 weeks of the first 52 weeks after the move. Or the taxpayer must be self-employed for 78 weeks of the first 104 weeks after the move. Now, if the taxpayer has not met the time test, but they believe they're going to do so, they can go ahead and claim the deduction. And then if they fail to meet the time test, they'll have to amend their prior return, or they will have to include the deduction as income. Now, if there is a situation where there's like an emergency or you get laid off, so for example, you moved and then you were fired or laid off from your job and didn't meet the requirement, you can still claim the deduction. So what are the expenses that are allowed for the moving expense deduction? Well, taxpayers are allowed to take their mileage if they're driving their personal automobile during the move. They're allowed to deduct the cost of moving, so such as a moving van or hiring movers. They are not allowed to deduct the cost of meals during the trip. They're also not allowed to deduct the cost of things like house hunting or breaking your lease, etc. Taxpayers are allowed to deduct the cost of staying in a hotel, though. For example, if you're moving and it takes you 3 days to get where you're at, you could deduct the cost of staying in a hotel. If the taxpayer is reimbursed by their employer, the reimbursement is a offset from the deduction. So you would add up all your expenses and then reduce it by the amount of the reimbursement. Okay, great. Now let's go on and talk about a couple more indirectly related business activities. The next one is health insurance. So this is a great deduction that is allowed for our self-employed individuals. So individuals who are self-employed are allowed to take a deduction for the premiums that are paid for their health insurance. And they're allowed to take a deduction for themselves, of course, for the taxpayer's spouse, for the taxpayer's dependents up to the age of 27, under the age of 27. Now again, this is a deduction for AGI, but the deduction is only allowed to the extent that the taxpayer has self-employment income. This is a great benefit for taxpayers who are self-employed. Now we have another benefit for taxpayers who are self-employed, and that is the self-employed tax deduction. So when we have an individual who has self-employed income, they are subject to self-employment tax, and they're going to pay both the employee and the employer's share of Social Security and Medicare taxes. And because if they were a Schedule C, or if they were a regular corporation, they would be allowed a deduction for the employer portion, they're going to be allowed a deduction on their tax return for the employer portion. Oh, I'll have to plug my laptop in. For the employer portion of the amount of the self-employment tax. So this is, in this chapter, you won't have to calculate the self-employment tax. It'll be given to you, and it'll tell you this amount represents the employer portion, and that would be the amount that a self-employed individual would get to take as a deduction for AGI. Okay, now we will move on to our deductions that are specifically allowed for taxpayers that are not related to business activities. The first of these deductions are my qualified educational loan interest expense. Yes, that's the one we want to start with. Qualified educational loans interest expense. So Congress has created two important deductions to encourage higher education expenditures, to encourage taxpayers to go to the university and community colleges. These expenses are allowed as deductions for adjusted gross income. The first one is a deduction that's allowed for interest on a qualified education loan. So this is a deduction that is allowed for the amount of interest expense that a taxpayer pays on their student loans. The deduction is not much. The deduction is $2,500, so an amount paid up to $2,500. But we have a adjusted gross income limitation, and that is the $2,500 is allowed if you are not over $65,000 if you're not married, and if you're married, the amount is $130. Now, please check the book to make sure that those dollar amounts have not changed, because as we know, the dollar amounts will change every year. And so if the amounts have changed, make sure you're using the correct amounts on your homework. These amounts are often changed depending upon what the index rate is. Now, after a taxpayer gets over $65,000, if they are between $65,000 and $80,000, or $130,000 and $160,000, the taxpayer is going to go through something that we call a phase out. And this is the first time that we've talked about this terminology called a phase out. And essentially all a phase out is it is a reduction of the amount of the deduction allowed, and a phase out will reduce the deduction all the way down to zero. So for example, once a taxpayer gets over $80,000, there's no deduction allowed for student interest expense. We're going to work a problem at the end of this video that walks you through how to do the phase out. So we'll go through and look at that calculation. The other expense that is specifically allowed that's related to educational expenses is a deduction that's allowed for qualified educational expenses. Now, this is the deduction that is provided for taxpayers who are currently going to school. So for the purposes of this deduction, you are allowed to take a deduction for your tuition and your fees that are required for enrollment at a institute of higher education. This could be a community college or a university. The amount of the deduction is $4,000. And again, this is for taxpayers that are up to adjusted gross income of $65,000 or $100,000 if they're married. There is also a phase out that is subject to the qualified education expenses. So be careful about that phase out. Now, for the exam, students always ask me for the exam, do I have to memorize the $2,500 for interest and the $4,000 for the qualified education expenses or the phase outs? And the answer is no. You need to know the general theoretical rules related to these deductions, but you do not have to memorize those dollar amounts. If you have to do the calculation on the exam, the dollar amounts for these deductions will be given to you. Okay, so we are now ready to work our first example, and then this will be the end of our first video. So the first example that we're going to look at is a general overview of the deductions. Okay, so this is the first one. So in this situation, it says, this year Jack intends to file a married joint return with 2 dependents. Jack received $162,500 of salary. He paid $5,000 of interest on loans used to pay for tuition for his daughter Deb, and he also paid moving expenses of $4,300 and $24,000 of alimony. And it wants to know Jack's adjusted gross income. Sophie, hey, I'm sorry, my dog is being very noisy. Be quiet. I'm recording a video. Okay, so let's look at this deduction. So this example is much easier than the type of example that you're going to see on the exam, because in this example we only gave you deductions that are FOR AGI deductions. But on the exam you're going to need to be able to characterize for versus from deductions and make sure that you put them in their right place. Okay, so we will start with our gross income, which is $162,500. That's the amount of the salary that the taxpayer received. Then I'm going to take off my deductions for AGI that do not have a phase out. So that would be the moving expenses and also the alimony. Remember, alimony is a deduction for AGI also. We talked about that in the last chapter. Okay, then now I'm going to be allowed to take a deduction for this $5,000 of student interest on a student loan, even though it's for his daughter, and that's because his daughter is a qualified dependent of his. So now we know that for the student loan interest, if you remember, although he paid $5,000, he's only going to be able to take a maximum of $2,500 of that student loan. But if you remember correctly, if you are married filing joint, which he is, he's going to have a phase out of that student loan interest if his salary is, or if his adjusted gross income is above $130,000, and it is in this case. So let's figure out his adjusted gross income before the student loan interest. So we'll take $162,500 minus $24,000 minus $4,300, and I will get $134,200. Okay, so we are definitely over the $130,000. So here's how we do that calculation. We're going to take the $2,500, which is the amount that he is allowed. We're going to multiply it by a ratio. The ratio is going to be his modified adjusted gross income, $134,200, minus the phase out amount, $130,000, divided by the phase out amount, $130,000. So I'm going to get a amount of, I should have done this math ahead of time, but that's 4,200 over 130 times 2,500. Okay, so we're going to get a phase out of, let's see, I'm sorry, hold on for just a second. I wanted to check my formula and I had my formula incorrect. So let's make sure that we notice this difference here. The denominator on the ratio is 30,000. It is the amount that's given in the table. Let's look at the table. Okay, it's the amount that's given in the table. So here's the table. I just copied and pasted this over from your book. Now remember, if you're looking at the at a different edition of the book, you need to check to make sure that the amounts have not changed. Oftentimes they don't, but sometimes they do. So here's the phase out calculations down here. So see, here's that calculation. Modified adjusted gross income minus 130,000 divided by 30,000. That's where I made my error at. So let's do that calculation again. Okay, so modified adjusted gross income minus 130,000 divided by 30,000 multiplied by 2,500 gives me a phase out amount of $350. So if he was allowed 2,500, but we have to phase out 350, his deduction that he's allowed is only $2,150. So now we'll subtract that amount, and then we will get his new adjusted gross income. Okay, now again, this is just an overview example of many of the topics that we talked about in this video. I'm going to post some additional examples for you to go through in the Connect product. So be sure to check for Chapter 6 additional problems. Remember, it'll be optional, but I highly recommend that you take a look at this because the homework doesn't cover everything in the chapter, and you need to make sure you're familiar with everything. Okay, great. That's the first video. The second video that we'll be talking about deductions from adjusted gross income are below the line deductions.